All right, guys, welcome back to the channel. Today we have a jam-packed episode, super informative. Today we're going to cover the 5 common mistakes made by first-time home buyers. If it's your first time on the channel, my name is Eduardo Duran, Austin real estate agent. Today I'm here with my preferred lender, Josh Hanley.
Hey everybody, Josh Hanley here with First United Bank, Austin, Texas. Been in the mortgage business, for about 24 years now, long time. Here in Austin, about 13 years. Love working with first-time home buyers, repeat buyers alike, and happy to be a resource for y'all.
Cool. Thank you, Josh. First mistake, number 1 on the list, is going and looking out for homes before you're pre-approved. Josh, would you like to elaborate a little bit?
Yeah, that's the biggest mistake that we see. People want to contact a realtor, have you put them in their car, get out there, start looking at homes before they know what they actually qualify for.
Yeah, and that honestly sets you up as a consumer for a disappointing experience, because let's say we go and you tell me that you think you can afford 500 grand or 600 grand, but then, as an agent, I wouldn't go show you those homes until you're pre-approved, and there's a reason for that. It's not that I want to lock you in or be very restrictive. It's more for your experience, right? Because if you can actually afford 5 or 600K, then, we can go see those houses. But if they talk to Josh and they only, 400, 450, if we've been showing you 500, 550, you're just going to have your hopes way higher than what you can actually purchase, and it's not going to be a smooth transaction.
Exactly. We want to make sure we're looking at the right price point. More importantly, affordability and what a client or a consumer is comfortable paying. Oftentimes they'll shoot for that higher amount, but then when they see the monthly payment on paper, it doesn't work for them. They get that sticker shock, scares them completely out of the whole home buying process. So definitely something to prevent up front.
Correct. And I also want to clarify, there's a big difference in between maybe what you're approved for and what you can comfortably afford. And when you actually speak to a professional like Josh here and they give you all the number breakdown, you'll have a much more positive experience buying a home, just because they say you can afford 3 grand. Maybe once you actually look at it, maybe 27 is what we want to look for. And he can help do the math to figure out what purchase prices we should be looking at. And that's where I come in as a realtor.
Exactly. Yeah, don't do it backwards. Don't get out there and look at homes first. Get the numbers in order. Make sure you're comfortable. That way you guys can get out there confidently, find the right home, and submit an offer. And if everything goes well, get under contract.
Nice. All right, guys. Mistake number 2 is going to be using the incorrect loan product. There's a ton of products. Josh is an expert on all of them. Go ahead and elaborate a little bit about what you've seen in your experience in your illustrious career.
I mean, definitely I can say that the biggest misconception is everybody thinks that FHA is going to be the end-all be-all, the best first-time home buyer program that there is. Because back in the day, that was the case. And that's a very old-school mentality, especially with younger home buyers talking to family, like their parents, their grandparents, whoever it may be. But FHA these days is more designed for people that have more issues when it comes to qualifying. Maybe you need more flexibility on the debt-to-income ratio, have a lower credit score. FHA is going to be more forgiving with a lower interest rate, lower mortgage insurance premium with a lower credit score. But if you have over a 700 credit score, we shouldn't be looking at FHA. We should be looking at conventional, which as a first-time home buyer allows you to put as little as 3% down, which is even more competitive than FHA. And you don't have that permanent monthly mortgage insurance going forward, and you end up saving a lot of money in upfront mortgage insurance premium fees as well. So narrowing down the right program, talking to a lender who's going to educate you on all options and not just steer you towards one product is definitely detrimental in the process.
Yeah, I've seen the same thing in my career. A lot of people have the golden standard of the FHA, and they think that's like specifically the first-time home buyer loan. However, if you can go conventional, I always like to recommend that my clients do so. The biggest difference, if you're going to be in the home for a long time, like he mentioned, is all the different fees associated with private mortgage insurance. With an FHA loan, that never goes away, right?
No, exactly.
There's one specific case where they put like 10.
Yeah, if they put over 10 or 11% down, then they can go ahead and get that reduced after the 11th year or have that canceled. But that's a long time to be paying mortgage insurance, whereas a conventional loan, you can actually cancel that after just 2 years in most cases of having that loan, as long as you have 20% equity at that time.
Yeah, I was going to clarify, it's not a time basis, it's when you reach 20% equity. And does it automatically fall off, or do you request?
No, with conventional, it is a 2-year time requirement, though, just FYI on that, but you have to have the equity eligibility as well. But it's something that you have to reach out to your lender and request. They'll have you pay for the appraisal, send the appraiser out. If the value in the equity is there, then they'll cancel that, reducing your payment significantly. So definitely take action. If you're already a homeowner and you've got PMI on your loan for several years and you're in a conventional loan, You may want to talk to somebody, do some research, and see if you can get that dropped.
Nice. And what would be a typical range? Let's say a $500,000 house that someone purchased. Like, how much is the PMI even month to month?
Well, that can vary based on
a
credit
time.
score, how much they put down initially up front. But I mean, with a $500,000 home, you could be talking about upwards of $250 to $280 a month.
Crazy.
It's a lot.
Crazy. Moving on, guys. Mistake number 3 is when a home buyer puts down more money than they really need to. You want to elaborate a little bit about why this could be a problem?
Definitely. That, again, goes back to that old school mentality of thought that parents, grandparents are telling you need 20% down to buy a home. Simply not the case. Now we have these low down payment options. Depending on the loan program, USDA, VA, 0 down, conventional first-time buyer, 3%. Oftentimes, people want to throw their whole nest egg at the down payment because they think it's going to help them with affordability and with their payment. But in reality, every $10,000 you put down towards a purchase saves you on average about $50 to $70 a month on your payment. So it's not huge. And why give up that security and give up that nest egg to all your savings when you're going to have a lot of other unexpected expenses when you move into a home? Moving expenses, furniture. There's going to be emergencies that come up. You just don't want to leave yourself in a situation like that. Plus, you don't want to delay buying a home because you're trying to save more money when it's not necessary. We live in Austin. Prices are expected to go up. You're going to improve your equity position down the road anyway. So even if you put 3 or 5% down now, in a few years, you could be at that 20% mark already. And then you saved all that money or you reinvested it somewhere else in the market and got a larger return. So it just gives you a lot more options.
Yeah. 2 main things that are important to unpack is, one, every $10,000 you additionally put down is only going to save you like 50 to 70. So really, they're not a very good trade-off in my opinion or in yours.
Yeah.
And second, a lot of people, it's kind of like a funny thing. They want to save up a bigger down payment, so they'll put off the purchase and they'll wait and wait and wait to try to build up that percentage that they want to put down. But by the time they have that amount of money, the house is now worth way more, and 20% that they wanted now is a higher number. So they just keep chasing this, they might think they need $100,000 saved, and then because they want to buy a $500K house and put 20 down. But then by the time they have the $100,000, now the house is 600, and now the 20% of that is 120, so they're 20 grand short. So oftentimes, we're not saying that you should rush into a purchase, but if you speak with a realtor and a mortgage lender that can give you a very clear picture of what you can afford and give you some statistics as to what likely is going to occur in the market, you can make an informed decision.
Definitely. 100% agree.
Cool. Mistake number 4 is overextending or opening unnecessary lines of credit, especially like while you're in the shopping phase, or even worse, once you're under contract.
Yeah, debt to income ratio is a very important factor when it comes to affordability and what you can qualify for. So debt to income ratio essentially is your gross monthly income before taxes compared to all of your monthly expenses that are reporting on your credit, including the new mortgage that you're trying to qualify for.
Okay.
So if you go out and buy that expensive car and get that $1,200 car payment, that's going to affect your affordability with a house. Or go out and extend a line of credit, or extend all your credit cards, making all of your payments go up. That's going to really affect overall qualification. Another big thing we see with that is people, once they're under contract on a home, applying for new credit or opening new credit or buying a car while their loan's in process. They may have qualified before, but guess what? Now they may not because of that new payment. Everything blows up. Everybody's unhappy, and it's all because they weren't educated up front and did not know any better to avoid a mistake like that.
Yeah. And just for reference, what's a typical DTI, debt to income ratio, that would be acceptable for someone looking to buy a house? And does that change depending on the loan type, whether it's
It does
FHA
depend
or
on the loan type. We'll just use a couple for example. FHA allows you to go the highest, giving you that flexibility. Just the expense for the house alone up front typically can't exceed more than 45% of what your gross monthly income is. Okay. But if you take that payment combined with all your other consumer debt, credit cards, student loans, car payments, that all combined with the housing expense cannot exceed around 57, maybe up to 58%, which is really overextending. You never want to put yourself to the max, but that's how high you can go. With conventional, it's going to be just straight 45% on average on the housing expense plus house plus all other debt. So we really have to take a look at that overall debt to income ratio to make sure that you're in line and where you're at.
Okay.
But most importantly, just don't make any financial mistakes when you're under contract on a home, because buying a house is going to be the hardest thing you can qualify for. Buying a car, getting a credit card, pretty much anybody can qualify for that because they're flexible on the terms. buying a home can really explode in your face if you're going to go out and do something like that while in process.
Yeah, and if you already have, if you're already deep in the contract phase, you've put up a lot of deposits and things like that, you can really stand to lose. So definitely something to avoid, and that's something that an educated realtor / a mortgage lender would make you aware of.
Exactly.
Last but not least, mistake number 5 is when you switch jobs or you quit your job when you're looking for a house. And specifically, if you can elaborate on the challenges and hurdles that come up if someone switches from a W-2 job over to a self-employed 1099, what challenges that brings up?
Very common, we see. I mean, unfortunately, some people don't have the choice, and maybe they're under contract on a home and they're laid off from their work, which can make them no longer qualify for the purchase. Good news is, as long as you're going into the same or a similar line of work and you've got an overall 2-year experience in that position, or even with education, which counts as experience, we can use that new position right away going forward. As long as it's salaried and you have an official start date, we can use that immediately. But you definitely don't want to get under contract on a home and then go out and switch careers, do something completely new. Then you're looking at having to start over that 2-year waiting period. You definitely don't want to quit your job because it's all about repayment ability. And if you don't have a job, you can't pay your mortgage. A lot of people, obviously self-employment offers a lot of benefits, working on your own, a lot of tax benefits. You can obviously make a good living doing that. But it's not the time to switch from W-2 position to self-employment. If you plan on buying a home in the next couple of years, it's going to be required that you're self-employed for at least 2 years before you can qualify. We have to show 2 years of tax returns to average out and see what the consistency is of your income. So by all means, just don't make any major life changes at all until you close on the home. Then you can go out and do what you want.
Yeah, well said, well said. Couldn't have said it better myself. All right, guys, that wraps up the 5 common mistakes that home buyers make when they're looking to buy their first home. I hope you enjoyed the content. We had a lot of value added here by Josh. Josh, if someone wants to get in contact with you, whether it be to ask you a mortgage-related question or even to apply to try to buy a home in the central Austin area, how do they do that?
Well, yeah, I think it'd be a good idea. Let's definitely include our information, maybe here down below, and you can reach me there. Josh.Hanley at firstunitedbank.com, all spelled out. Local here in Texas, but nationwide, so I can basically help you anywhere in the country, whether it's buying your own primary home or an investment property or whatever it may be. Happy to be a resource and to help, whether or not you do a loan with me or not. So feel free to reach out. Cool. Appreciate it.
Subscribe for more content just like this.